friends. Welcome to The Skinny on Wall Street with Kristen
and Jen.
Everyone has been asking recently, is there this AI bubble? And so what inevitably happens is people turn to anyone who in the past called bubbles correctly. So one of those people was Michael Burry, who was one of the first major investors to short the subprime market in size leading up to the collapse of 2008. And so he has been out with this warning about what the big tech companies are doing with a very minor accounting assumption and saying that this is this mega accounting scandal and like there's a bubble because of this one little assumption. And so we want to break down exactly what that means. And then Jen is going to fill us in on what has been happening in the fixed income markets as of late ahead of the Fed meeting in December. So let's dive into the Michael Burry story. So he's been in the news because not only is he screaming from the rooftops about this accounting scandal, he also is deregistering his fund. So Jen, you had some speculation about like what's going on with that too.
Well, yeah. So he is returning outside capital, and so there's speculation on social media. There's copies of a letter floating around that I have not been able to verify whether or not it's real, suggesting that he was closing down his fund because his estimation of the market has been out of line with pricing reality. Yeah, exactly. I simply don't know if that is real or not. But there's twofold speculation. One is that he's returning all this outside capital because his returns have been terrible and he's shutting down. Or one can deregister their fund with the SEC and simply become a family office, and you don't have to go through all the same kind of disclosures that you do when you're managing outside capital. So it makes it a lot of famous hedge funds have done this, not because they blew up. Like Soros, Blue Crest, all these guys became family offices because they were like, we're done managing outside investors' money and having to deal with them all day. Let's just manage our own billions and billions of dollars and effectively become, like I said, a family office. So I don't know which is true. We'd love to have Mr. Burry on the podcast and learn a little bit more about what he's up to. But the speculation is that he just got the AI call wrong and is kind of tail between his legs, ducking for cover. I simply don't know.
All right, so let me back up for a second. So Michael Burry is saying that the big tech companies, so Meta, Oracle, whoever, they are overstating the quote unquote useful life of their GPUs. So GPUs, if you're not familiar with them, those are basically these chips that are used to train and power these AI models that they then use to sell product, right, to support their revenues. And by extending the useful life, that has a very meaningful impact on earnings. And so I want to basically go through how that works because it's a minor point, but I think that it's important to understand A, like what does the accounting say? B, how does that translate into valuation? C, how does it potentially impact cash flows or not? And then is this the big scandal that Michael Burry thinks it is? I personally don't necessarily think so. Maybe I shouldn't give that away ahead of time, but we need to start by basically walking through this idea of depreciation and the useful life and how it ultimately impacts earnings. So first of all, when a company, right, Meta, whoever, when they make a big investment, so they buy GPUs, they like whatever, invest in these data centers, they need to account for it in some way. Now, unlike private companies, so like the dumpster fire that is Jen, you're in my like chaos that is our financial reporting because we just don't have to do anything. Like nobody sees our financials except for the two of us. When you are a public company, you have to adhere under a set of standards. So in the US, the standard is US GAAP. And in the rest of the world, minus Japan, they use something called international financial reporting standards. The point is that the goal of these is to like kind of make all the financials clean so that a investor, like a retail investor, a sophisticated investor can look at it and be like, I know what's going on versus like, here is our random spreadsheet of a whole bunch of data dumps. And like, you need to now make sense of this all. So under this, what's called generally accepted accounting principle, there is this idea of, I mean, again, this sounds boring, but like this all is how Michael Burry is saying, oh, they're manipulating everything. Like when you have this big investment, let's say you spend $100 million on chips, the company management has to allocate that $100 million spend over the life of the property, plant, and equipment. So for example, right, you spend $100 million on chips, and let's expect that these chips are obsolete after 3 years. So after 3 years, they don't work anymore. You need to go out and buy new chips. What happens is that management then would have to say, okay, I am going to take the $100 million and I'm going to evenly split it up over those 3 years. So I have a what's called depreciation expense that represents like the utilization of this asset of $33 million for 3 years. Now, the thing is that that is a non-cash expense, meaning it is lowering your earnings, but you don't actually have cash going out the doors in, call it years 2, 3, and 4, assuming you bought the chips in year 1, because the cash went out the door in year 1. in years 2, 3, and 4, you just have this accounting expense that then is not cash that you then see as like this non-cash add back on the cash flow statement. Now, I think it's important to understand, you might say to yourself, but wait a second, this is an expense. Doesn't it lower your earnings and doesn't that impact taxes? The answer is no. The IRS and like accounting are not the same. Meaning you can show 33 million of depreciation next year, the year after, the year after that, and that has nothing to do with what you can deduct with the IRS. And in fact, the IRS is very generous because of the big, beautiful bill. You actually are able to deduct, I believe, 100% of that $100 million in the year that you actually spent it. So that is what's called that 100 million bonus depreciation, whatever. So point is that this doesn't affect, like the depreciation assumption doesn't affect your freaking cash flows at all. Like it doesn't shield your tax. It doesn't do anything. It is purely an accounting charge, but it does impact your earnings. By the way, why does it impact your earnings? Because if you think about like an income statement, so you have what your revenues are, you then have your expenses. One of those expenses is depreciation, which means your earnings go down by depreciation. And so that is going to impact your earnings. So with that said, let's go back to this whole idea of the assumption for useful life. So when we had an assumption for useful life, if it was 3 years, right, you have a $33 million expense in years 2, 3, and 4. What if instead you say, oh, I think I'm going to actually be able to get 5 years out of this asset.
20, right?
Exactly. So when you take 100 and divide it by 5, you get 20 million. That is 40% lower than 33. Oh, wow. Your income is going to get bumped up. So it makes your income in the next few years look inflated versus what it would look like if you used a 3-year useful life. So this is the scandal that Michael Burry is yelling about. Here's the thing though, like how does this translate to valuation? Because when we talk about valuation, earnings and valuation are not the same thing. In valuation, there are 2 primary valuation methodologies. There is something called comps, meaning you look at comparable companies. I'm going to talk about that in a sec. And then the discounted cash flow analysis, or the DCF. So if we're talking about comps, probably the most important thing to understand with different companies and different industries is what metric and what multiple do you care about, right? So if you were to go and like sell a house, you're looking at price per square foot. If you are going to sell a company, you might look at something called the PE ratio and earnings per share. You might look at enterprise value to EBITDA. You might look at something else entirely. And so that is really dependent on the company in question and the industry. Now, big tech does in fact trade typically off of a PE ratio, which means that earnings per share number that Michael Burry is so like focused on actually is important in this industry. Exactly. So like just very rudimentary math, you can sometimes think about like you can approximate what you think is a fair stock price by taking some PE ratio where you see where similar companies are trading, multiplying it by the EPS. So if EPS goes up, then all else being equal, the stock price should go up too. So the inflation of earnings does potentially have a very meaningful impact on that stock price. However, I would argue this should not be used in a vacuum. Like looking at PE ratio alone and calling it a day is the laziest way to invest, like period, full stop. Oh, and so anyway, like that is just lazy. So typically what happens is that if you're an investor, you're going to look at other methodologies. And by the way, you also don't have to just look at EPS. You could look at another metric. So one of probably, I would argue, the second most commonly used metric for valuing a business is what's called the enterprise value to EBITDA multiple. EBITDA is a proxy for operating cash flow. It stands for earnings before interest, taxes, depreciation, and amortization. And this basically means that whatever you chose for depreciation has zero impact on this number. So it's added back. Like, so it literally doesn't make any difference at all. So if you were focused on, say, an enterprise value to EBITDA multiple, then
you wouldn't care.
The useful life makes zero difference. Exactly. And so, okay, so one other metric, it doesn't really impact anything. One metric it does. But then there's the DCF, right? The gold standard. And so the discounted cash flow analysis is what you basically, if you go to business school and you learn about, like it's funny, business school professors look so down on comps analysis. It's like a lower it's a lower analysis. The DCF is the gold standard. But basically what happens here is that you project the cash flows into the future and discount them back to today. Remember, depreciation is non-cash. But I would say it sort of is important in 2 ways. Number one, it can be helpful as a sort of tool for approximating the cash taxes because you're calculating hypothetical taxes based on EBIT. But we already said that the accounting depreciation actually has nothing to do with the tax depreciation. So like technically, whatever the DNA assumption is chosen, like shouldn't affect the DCF at all. The only way that the assumption for the useful life indirectly relates to the DCF is how it then is incorporated into the projected CapEx. So what I mean by
you
that,
need to go buy more chips in
exactly.
5 years versus 3 years.
Exactly.
It's a different expense.
Exactly.
Yes.
So that's the whole thing, right? If these chips are burning out after 3 years and not 5, then you have to invest more. And it means that your CapEx is going to be higher. It's going to be, going faster. And so this is why I would say it's important to understand like what you think the useful life is. But again, the number that Meta chose for accounting assumptions is arguably irrelevant. It should matter more like what you as an investor believe is like the replacement cycle and all that, and what the business's future investment needs are. The specific assumption for useful life in accounting, that's, I would argue, relatively irrelevant. Like you shouldn't necessarily just blindly accept the depreciation that's in the 10K. You probably want to be looking to see like, well, what does research think about this? What is da-da-da-da? What did the experts say? So with all this said, it's like, cool. But is Michael Burry right? Should we assume the company needs to upgrade these chips after 3 years instead of 5? I'm going to say here, like as a non-tech expert, I have no fucking idea. I have heard.
Are they even going to be using these chips in 3 to 5 years? Like, is the technology just totally going to change? And like all of this is just a mental masturbation exercise.
Well, again, it's funny. I listened to the All In guys who were like, Michael Burry's full of shit. He doesn't know what he's talking about. Like, this is so stupid. You definitely can use them for 5 years. They'll find other ways to use them. And then I was listening to the Big Technology podcast, and I forget who they had on, and they were like, Michael Burry is absolutely right. So again, I have no fucking clue. I am not a tech expert. I will say, I think it's interesting though, just as like a real world analogy. So Jen and I, obviously here at the Wall Street Skinny, our one huge investment is our computers. And my company that I used to work for, they would depreciate their computers over 3 years. I mean, we're on year 3. I'm hoping I don't have to freaking buy a new computer. So again, like, not that this is some like magical thing, but it's like, this assumption is like, you can also know exactly what a computer is, how it works. I can have experience using it in the past, and I still don't freaking know like what should be used as the useful life of this stupid computer. So, I mean, if you're an investor, you probably should be doing more work than just saying, I'm going to look at my earnings per share, slap a P multiple on it, and call it a day. Like if you're a sophisticated, know what you're talking about, like you probably want to do a little more analysis. And this is the whole beauty of markets is like, you can have Michael Burry who thinks that the assumption is dog shit and that these companies are super overvalued. And you can have people short the company or sell. And you can have people, like the All In guys who are like, the assumption is great and it's not a bubble. Michael Burry doesn't know what the hell he's talking about. Awesome. They can invest. And that's the whole thing. It's like the market is supposed to find what the right price is and business as usual.
Makes for a good market and a good story.
Exactly.
And if you're getting that classic question, how does $10 of depreciation flow through all 3 statements?
Yes.
You then obviously have a framework to talk about why it matters. So there
right,
you go.
Exactly. Apparently, like the AI companies are potentially understating their earnings by a significant amount. So anyway, with that, Jen, why don't we dive in and talk about the fixed income markets and what's going on there?
Well, yeah, so it is the day after Thanksgiving. We have a Fed meeting coming up in 12 days. And I think it's actually really interesting to think about where the market sits. If you will recall, we have experienced a dearth of reliable economic data in the US since September's Fed meeting. And that's been pretty problematic because the data that we've gotten doesn't seem to match up with what you just hear and feel anecdotally.
Yeah.
And the next set of data we are going to get, so the Fed meeting is going to be December 10th. We will get the next payrolls report on December 16th, and we'll get CPI on December 18th. Wow. So we've got yet another Fed rate decision that's going to happen in the absence of I would argue, 2 of the most critical pieces of data that we have on both the employment picture, which points to growth, and on the inflation side. Thinking about the Fed's dual mandate, obviously, to maximize employment and maintain price stability. I don't know about you, but the conversations we're having around the Thanksgiving table, every article you see is like new college graduates are experiencing unemployment at rates not seen since God knows when, and at orders of magnitude higher rates than more senior people. So while we talk about the impact of AI on people's jobs, we've had massive waves of layoffs at tech companies. And I know the party line is that it's not because these jobs are being replaced by AI, it's for all these other reasons. And that's fine. We may still be early on seeing AI trickle through, but it feels like things are not that great on the growth front. And it feels like inflation remains high while wage inflation does not. So again, we talk about like the vibes of the economy, if you will, like they don't feel great right now.
Yeah.
And we went from getting a stronger than expected payroll report that led the market to suddenly panic and think that the Fed's not going to go in December, to now having switched back to the market as pricing in an 85% chance of the Fed cutting 25 basis points at the December meeting. Now, the tension that we have is, okay, the number of meetings that Powell has left on his term is not many, right? So what is he going to do over the course of those meetings to maximize and preserve optionality, which is what I think he was doing during the press conference, where he surprised the markets by saying, like, if we decide to resume rate cuts in December, I think, again, what he was trying to do there was just keep as many options open as possible. Now, one thing that we always kind of forget is the Fed doesn't have to act at its meetings. The Fed can act intra-meeting. So they could wait, right? They could say we're doing nothing on the 10th and then do something once they get the data on the 16th and the 18th. But the question then is, if you think about the calendar, when are they going to do something on like Friday afternoon, December 19th? Like, everyone's leaving the office. Liquidity is going to be horrendously thin. Like, it's the holiday and the following week. Like, that's not a great time for the Fed to do something and give the market like 5 minutes to react to it.
Right.
So they could do a lot of signaling up front if they're going to do that. But so that's something that we're going to be thinking about. I think that the Fed may go here in December and then pause in January. So right now we're pricing in basically a high likelihood that they go now, and the market's not so sure about whether they do anything in Jan. And then as we think about it too, we've started to think about who's going to be replacing Powell next year. And the name that has emerged as kind of the front runner, at least at this point in the game, is a man called Kevin Hassett, who unsurprisingly tends to be more dovish. And so I think the market anticipates that he will, the question of to what extent he will simply be a mouthpiece for whatever the administration wants is TBD, but he will definitely be more on the dovish side. So thinking about what level of optionality Powell wants to build in before you get somebody pretty dovish coming into the seat, likely in the spring. I mean, no matter what, whomever is nominated is going to be, someone who has curried the favor of the current administration. But I think the question is to what extent will he be super dovish? To what extent will other committee members balance this person out? Et cetera, remains to be seen. So where does that leave us, right? We had a yield curve that was steepening kind of all year long until we got to September. And it's been chopping around now. And I think all else being equal, I'd be more bullish on the front end of the yield curve, meaning thinking that rates are going to likely come down there in one way or another, whether the Fed is going to cut or whether we're going to get a more dovish person coming into office. In terms of the credit markets, which we've been talking about a lot, I think as we start to think about what to expect going into 2026, we had this going back like really 3 years, right? Thinking about when the Fed started its hiking cycle in 2022, we have this world now in which you've had a higher rate environment. And when you think about all the bonds that everybody owns, the coupons on those bonds are high, right? Relative to the previous 15 years, you've got high coupons that every time they come in, generally speaking, unless you're a retiree who actually need those coupons for their income, those coupons are getting reinvested. So there's been just this perpetual wall of cash coming into the credit markets. And everyone's been belly aching about the fact that credit spreads are so tight. Well, they're tight relative to treasuries and they're tight relative to global, government bonds, because there's been a crisis of confidence in fiscal policy in all of the developed countries. If you look at credit spreads relative to SOFR, and swap spreads are negative in most countries, meaning that swap rates trade below government bond rates. That's not how the world used to work. Swaps used to trade cheap to, meaning at a higher interest rate than government bonds. But because we've been in a regime of fiscal irresponsibility, globally speaking, for however long, we now have negative swap spreads. So when you think about corporate bond yields relative to swap rates, okay, they're tight, but they're not as tight as they are. You've had just outright yield-based buyers who have been that wall of cash relative to spread-based strategic buyers. And I think we've been in that environment where there hasn't been enough credit supply to meet that demand. I think what we're seeing and kind of what the story has been over the past couple of weeks and months is with these AI companies, the hyperscalers, issuing not just the project finance-based debt that we talked about for this really cool strategy that they can do, they're also issuing tons of just regular old corporate bonds. And I think that will continue in the coming year. And I think that's going to provide kind of the better balance between supply and demand in the credit markets. And I think that's what the credit market is kind of coming to terms with here in the final weeks of 2025, which is, okay, we no longer need to panic that we'll never be able to get our hands on another bond again. Bonds are coming. So we can all calm down a little bit. And I think that's what the credit markets are telling us. You do have these one-off incidents like Oracle, which has become, like you said last week, the anti-AI trade.
Oracle CDS.
I don't know, maybe buy puts on the NASDAQ versus like buying Oracle protection at whatever it is, 130 basis points now. Like that seems, I don't know, like, but expensive. Who am I to know?
Yeah.
It seems really expensive if that's the anti-AI trade, but what do I know? I think just more broadly speaking, though, I think 2026 is going to be more about balance in those markets. I don't think that we are seeing a canary in the coal mine that, okay, we need to be really concerned. Private credit is going to blow up the world. I think it's more a supply demand shift that seems to be taking place. Just to kind of circle back to the conversation we had last week and think about how that fits in the overall environment of potentially a more dovish Fed and what that all means. So those are my thoughts there. We did get an announcement in the UK that I thought was pretty interesting. So speaking of fiscal irresponsibility, and actually if you think back to kind of what kicked off like the global panic about fiscal irresponsibility, think back to 2022, I think it was, when you had Liz Truss in the UK announcing these massive tax cuts that sent everything into a spiral, right? And all these UK pension funds that are levered long were getting stopped out and getting margin calls. So the Bank of England had to step in and do emergency operations in the long end to stabilize things. I mean, it's been a long time since we were there. And now here we are in the UK, which has a whole host of problems. I think being a little bit of a proxy for these, global governments that are trying to find a way to solve their fiscal problems without increasing taxes massively on the median person and without cutting spending.
Yeah.
So how do you do that? Okay, well, the UK came up with a solution that the market seems to have reacted well to. And I don't think it solves all their problems by any means, but one step in that direction. They announced basically a federal tax on all properties over £2 million pounds. So this is, and it's not a huge tax, by the way. It's a graduated tax, but what needs to happen now is there needs to be a reval of all these properties that haven't had a reval.
I'm curious, is this like a property tax, like an extra property tax, or it's a buy? Got it. Yeah.
No, it's not a purchase. It's not a
sales. Got it. Yeah.
Same time.
Or I don't even know what it would be called for like buy. Yeah. But I mean, do they not have that already? Like, cause that's
no.
So they
do not have a federal UK tax on properties.
Okay. Do we in the US? I feel like you would know that. All I know is we do pay taxes, but I didn't know. Okay. No, it's state by state.
You pay local taxes.
Got it. That makes sense.
Right? So
that makes sense.
Like your public school.
This makes complete sense. Yeah.
Taxes go to pay that, right? They don't go to the federal government.
Got it. Okay. Got it.
But in the UK, they will now. And like for our American listeners, what's a £2 million house? I think it's like 2.65 million US dollars based on current exchange rates or something like that. And it's not a huge tax, is my understanding. I was trying to do some research on it. But what happened is the UK bond market reacted very favorably, right? Because it's like, okay, some income, right?
Yeah.
The estimate was that it was going to start raising something on the order of magnitude of like $500 million a year for the government when it's
it.
I think it'll be implemented in 2028.
That's like nothing. Well, $500 million? That's like, I mean, oh my God, that's nothing.
Remember, their government is much smaller than we
are. Fair. I'm like thinking like our 36 trillion or however much our deficit is. So it's like if someone were to do something and it's like $500 million, you're like,
better fiscal scenario than we are. I think it's probably worse, but the order
they're a smaller.
Yeah.
Fair.
And also remember, Kristen, that property values have been collapsing over the past few years in this same environment. right?
Yeah.
So it's still incredibly, I think something like 88% of the properties that will be taxed are in London, because London is incredibly expensive.
Yeah.
But with all the non-doms leaving and things like that, with all these policies that have been put in place, like the marginal buyer of UK properties has been no thank you.
Yeah.
And this will only increase that, right? Because if you imagine, right, if you're a landlord, if you're someone who is renting out
Yeah.
properties, if you're an investor, so at the margin, it's negative for UK property values, but it has been good for the UK bond markets, which when just thinking about kind of the overall story of fiscal irresponsibility, like it coming back to that apocryphal story of what happened there a few years ago is always relevant.
Well, yeah, and Brexit didn't exactly help.
Right.
Yeah.
So, I mean, again, not a UK expert whatsoever, but I do think it's just interesting watching what happened there. And as we think about, the different ways we're trying to solve all the fiscal problems in the US, which don't seem to be going away anytime soon.
No, I mean, yes, no. Well,
yeah, that's kind of my like 2026 projections. If we're thinking about, just taking a step back. I know everyone's going to do their year-end market projections in December. I'm a little early with this, but just thinking about where we're going to be after we basically have the Fed, we get this data, and then the market shuts down for the rest of the year. Oh, we had a big CME outage this morning.
I did see that. I saw that.
Well,
yeah.
It's always something the day after Thanksgiving. We had Dubai World in 2009. Now we've got, there's just every year there manages to be some catastrophe. I don't know why the markets aren't closed the day after Thanksgiving. It's
well,
just shocking.
Yeah. I'm shocked that they're not. And also we're working. So what do you know? But by the way, guys, really exciting announcements. Number one, industry is coming back January 11th. So for those of you guys who like our industry debriefs, we've got to get on it. We have 6 remaining episodes in season 3. So we'll be caught up for season 4.
I thought we only had 5. Oh,
no, I thought we only had 5 too, but I looked and I think that our latest one was season 3, episode 2. So I think we're on episode 3, unfortunately. Not unfortunate. It's just that this is such a heavy lift for us with each of these. So we're like scrambling to try to get everything in the timeline. But also the big announcement, Black Friday. We do have a Black Friday sale if you want to check out our website. We literally just released our financial modeling class. We've had so many people asking us nonstop for that. And now we have officially rolled that out. So what do you get in financial modeling? You get basically 4 hours of accounting, which is, I know like everyone thinks is super boring and whatever, but no, it is sexy. Go back at the beginning and watch the rest of this video. But no. So, Warren Buffett puts it best. He's like, accounting is the language of business. And honestly, you shouldn't even be investing in stocks if you don't understand accounting. So you get accounting. We then do a 1-hour crash course in Excel. And then we have 8 hours of modeling. We build 3 different models. We build a simple private company model. It's over a 3-hour video just for that first one. We then do a simple public company. And then we do a real company. We use Fox because, again, best comp for Succession, for Waystar Royco. So we spend over 2 hours building out a real company literally from scratch. We go to the SEC website, we download their financials, we talk about how to clean it up and put it in the model and then build it all out and project it. We get into things like primary versus secondary proceeds because the Murdochs had a secondary sale. And TLDR, spoiler, it doesn't really impact things, but we talk about what happens with equity raises and all this kind of fun stuff. It was a lot of fun to build. It was also very intense. And so I'm so glad that it's out. So that is available. It is also, I should say, captured within our bigger investment banking and private equity bundle. So now if you buy that, you do get that financial modeling content. So the total number of hours of content in that is now 25 hours long. It is a lot, 10 models in there. And Jen, the fixed income pre-sale is still going on. I think you just dropped that second part 2, correct?
Yeah, so all of part 1 and all of part 2 are available if you buy our fixed income course on pre-sale. And part 3 will be complete and live before the end of the year, after which point prices will go up and we will no longer be in pre-sale mode. So yes. We hope all of you are enjoying it. My favorite thing is watching. I was really nervous, I'm not going to lie. I was nervous that it was going to be too easy, that people could be like, duh, I knew this. I think the pass rate on the first quiz is 15% for the first time people take it. So I was like, okay, we're good. Yeah. It's nice and challenging. And if you are one of the people who has taken 5 or 6 tries to pass each of the quizzes, good.
Hey, I got one of those questions wrong.
Exactly. But if you're looking for extra help, we are offering access to me and Kristen. So we are offering something we're calling office hours starting in January of 2026. For those of you who are taking our courses or not and just want a small group session to be able to ask us questions, Those office hours are available for purchase. It's going to be 3 1-hour Zoom calls. You can submit your questions in advance. They're going to be limited to small groups. So you're not having to clamor to be heard over 250 people, like in one of our master classes, asking Q&As at the end. This is really hyper-focused on you. So, make sure you sign up for those. Those are available typically as an add-on purchase if you're purchasing the course. And it's honestly the best resource you can imagine. So don't sleep on those.
Yeah.
That's the kind of stuff that we charge well over $1,000 for on the intro platform.
For 1 hour versus 3.
Exactly. So this is just amazing access to us where you can ask every burning question that's on your mind.
And by the way, if you want to add this on, if you bought the course and you did not get this, you can email us at info@wallstreetskinny, and we are happy to send you a link to sign on. This is meant to be just for people who bought the course. But again, if you did do that and you did not see this add-on, you can email us info@wallstreetskinny, and we can send you the link to sign up.
Awesome. Well, thanks, guys. Enjoy your weekend. We're off to go get our tree.
Us too. All right, yay. All right, thanks, guys. Bye.